Welcome, Matt. This is Tim. We're D1 Agent Group here in Phoenix, Arizona. We specialize in helping clients build tax-efficient real estate portfolios. So all the ins and outs of that, whether it's buying or selling or holding a property, cost segregation, all the stuff that you heard us talk about and seen us post about on LinkedIn, that's kind of our specialty. So.
Yeah. Real quick, when we speak with a lot of CPAs, we speak with a lot of clients who are full-time real estate investors. We invest in real estate. And one of the common themes that we saw was just a disconnect between the world of a CPA and kind of some tax strategy things that seem to a lot of times either be behind closed doors or just not known about. And then the actual implementation of those strategies out here on the other side in the real world with other real estate investors. And so we're trying to close that gap actively. That is what we do as a business. That's how we help our clients. We help with the tax strategy and forming kind of a real estate plan that's tax savvy for that individual. And then we help marry that with the actual implementation so that when you go to actually carry out that strategy, you're not getting dinged by the IRS and being like, I have nothing in place that I was supposed to. So we partner with CPAs. We have CPAs that we can refer to, but that's just kind of one of the most common gaps that we are trying to fill, I think, in today's industry right now.
Yep. Implementation of these plans where sometimes it fall a little bit short on the tax filing end sometimes, right?
Yeah.
Today we're going to be going over kind of the number one phrase that we hear thrown around when people are starting in this whole investment strategy. You run a cost segregation study, and a lot of people throw around the phrase recapture, the big scary phrase like, what about when you depreciate a property? What happens when recapture takes place? Scary word. Recapture and capital gains, those are the two I hear.
Yeah.
What about capital gains tax? I might have to pay taxes. And a lot of this is going to be talking about the kind of the way that we defer taxes overall. But that's all that we're talking about is just putting a pause on taxes that we will owe eventually.
Yeah. So in order to kind of give a broader context, if this is the first time that you're joining in on one of these calls, we're going to dive into what recapture looks like, why it's maybe not so scary if you got a plan in place, and kind of some things that you can do to continue to kick the tax can down the road and kind of combat what recapture would look like for you. But to give you broader context into what we're talking about, if this is your first time joining, let's go ahead and I'm going to share my screen here. We're just going to talk real quick about what real estate in general does for you, right? Because there's a lot of reasons why people buy and invest in real estate. One of those reasons is cash flow. That's a great, excellent way to, bring in some excess money. And, you're probably going to build that money tax-free because of a lot of the things that you can deduct on a rental property or an investment property against that income coming in from the rental. But at the same time, there's a reason why a lot of wealthy families invest in real estate in general. And so for a lot of our clients, they're successful business owners who are making great cash flow in the business, right? That is their main thing. That's what they're good at. That's what they wake up every day, and that's how they earn their money. Then what do we do from there, right? And that's kind of the specific niche within real estate that we've chosen to specialize in is, hey, how do we utilize what we believe to be the true power of real estate, which is the tax benefits of that side. So we're just going to map out real quick for everybody kind of just jumping in again for the first time, what this looks like, right? So when we're talking about tax benefits, we're always talking about it in perspective of active income and passive income. So the IRS is going to draw a line right down the middle of those two things. Now, on the active side, you're probably going to have you and your spouse, right? You're probably going to have, a W-2 over here if you've got a job, or if you own a business, you've got a 1099, right? You're paying yourself from that business. And on the passive side, you're going to have things like a retirement account. You're going to have rental real estate, which is what we're going to be talking about here. So let's just say that you've got a single family house and you're renting that out, right? And you're making some money every single month. It's cash flowing great. That's awesome. The best thing, the most powerful thing about this real estate is not the cash flow in what we've dealt with clients and what we see. It's actually the paper losses that we can create. So when you own a property, each year your CPA is going to file a Schedule E. That shows the income that you brought in with that property. And then they're going to go ahead and look line by line. There's 18 lines there of deductions that you can take against that income, right? There's a lot of ways to show loss, even though I bring in cash flow every single month.
Yeah.
And one of the biggest line items there is depreciation. Okay, so there's all sorts of ways that we can accelerate depreciation, but that is the number one way. That's the number one strength to real estate, is it's really easy to create a paper loss. So what do you do with these paper losses, right? So maybe you've cash flowed, $500 a month for an entire year. Great, you made $6,000. Well, let's say that you show on paper a loss after all of your expenses and depreciation, which is just taking the overall value of that structure and spreading it out over 27.5 years if it's a residential property. The IRS allows you to go ahead and just take that each year, a section of that, and deduct it against your income. So maybe we're over here and we're showing a $25,000 loss. That's getting a little small here. $25,000 loss. Where does that loss go? What happens with it? What makes this so special, right? Okay. Well, these losses go directly into our loss bucket right here on this passive side. And you're going to start to fill up this bucket. Now, these losses don't go away. You don't have to use them. You don't have to deduct them against income in that year. They can sit in this bucket. They're going to never go away. You can sit there and save them for a time when you need to lower either your AGI or your capital gains, right? So maybe you don't want to lose those losses this year. You save them in a bucket. Now I have $25,000. 25, bear with me with my writing here. $25,000 of losses, and I'm going to save it for when I go and maybe I own another property over here, and I'm going to be selling that this year, right? And I'm going to have a capital gains. Maybe I'm going to make, oh my goodness, I'm going to make $100,000 when I sell this property. Okay, so buy property, I make $100,000. What happens when I get taxed on that? If I've owned it for over a year, I'm going to pay long-term capital gains tax, right? So maybe I'm paying anywhere from 0 to 20% max on that. Well, what can I do to offset? I can dip into my bucket here, and I'm going to say, okay, well, I'm at least going to offset $25,000 of that $100,000 gain that I'm going to get taxed on, right? So then I can go ahead and lower that taxable the tax burden for that capital gains. Now, this is what normal people do. They have to stay on this passive side, right? Passive losses created here have to stay on the passive side, and they can help offset other passive income coming in. If you are a real estate professional, you get some cool benefits. If you qualify as a real estate professional, so if you're in construction or reconstruction, development, redevelopment, if you broker real estate, if you are acquiring real estate full-time, if you're managing real estate as well, and you're at least a 5% owner, and this is like your main job over here, right? You're most likely hitting some requirements required by the IRS to be considered a real estate professional. If you have that designation, what it allows you to do is then go ahead and materially participate in these properties. And you're going to say, okay, now I'm managing these properties over here. I'm going to actually take this loss, and it's now an active, it's no longer a passive investment. This property right here is no longer considered passive. It's now considered active, and I'm going to take those losses and I'm going to deduct them against my active income. Now, this is what we specialize in, helping people who hit that designation, right? So maybe you hit one of those categories I just listed. You're a business owner, you own at least 5% of the business, and it's your main gig. You're doing it more than anything else. You're most likely going to be able to buy real estate, depreciate it, take the losses, and offset the active income from your business. This is where we get super powerful things happening, is when we can go ahead and say, hey, you're running a business, you're making a lot of money in that. Let's go ahead and park some of that money in real estate. Then we're going to lower your AGI. Well, guess what? When you go back to buy a property, talk to your lender about this. When you go back to buy a property, you can actually get that AGI adjusted right back up when you go to qualify for a loan. They add depreciation from real estate back into your qualifications in terms of qualifying for lending, right? And so there's all sorts of really cool stuff, but this is just to give you a high level view of the power of real estate and why people don't just buy it for the cash flow. And you've heard this probably many, many times is, oh, there's great tax benefits with real estate. This is what they're talking about when they're saying that. They're saying, hey, you can actually create a paper loss with this real estate, even though you make money. Even though you make money at the end of the year, when you file with the IRS, you can show that there is a loss here, right? And then from there, we can do some cool things, whether you're going to stay on the passive side or whether you're going to transfer some of those losses and be able to deduct them against your active income, right? So in essence, this all we're doing is we're deferring our tax liability, right? We're kicking the can down the road. We're not getting rid of our taxes. You're always going to have to repay. But if we play that game long enough and we have a strategy in place and we're proactive in when we sell and buy properties and when we transfer that wealth and when we can 1031 exchange so that we're not having to actually pay the tax bill on that, if you can play that out through the rest of your life and you die, you get a step up in basis. And that's when we can pass these properties to your heirs. And that actually becomes now, you officially got rid of that tax bill, right? And so it's a game worth playing. It's a game worth playing. It's something that you need to know. Don't just say, hey, it's in the hands of my tax guy, I trust them, because there's 6,000 pages of tax code that CPAs and EAs have to understand and know. And a lot of them aren't specialized or well-versed in real estate. And so again, if you hit one of those categories that I had mentioned, rewind this video and ask your CPA or your EA if you qualify as a real estate professional. And if they're looking at you like, I have no idea what that means, or they don't have a clear answer, it's a good time to maybe reach out to us, and we can either help educate them, or we can, walk through some strategies and some different options that you might have ahead of you, and refer you to somebody who you might not, who you would like to work with, and who would know your situation a little bit better. So, yeah, that's in essence the kind of high level view. We're going to be again talking about recapture specifically, because when we buy a property and then we go to sell it, what happens when we've taken those excess losses that we haven't paid taxes on, right? Not just the gain, right? When I bought a property for $500,000, I sold it for $750,000. Not just that, right? That's if I've owned it for over a year, that's just going to be maxed out at 20% capital gains tax rate. But what happens when we take accelerated depreciation, right? Or depreciation in general? What is that taxed at? How does that affect you when you actually go to sell a property? So we'll talk about recapture. Matt, you want to take that?
Yeah, exactly. So when we talk about deferring taxes, the big trigger point, the point at which taxes become due is when we sell the property, right? A couple things get triggered at that point. We have a capital gain potentially or a loss that is addressed. If we have a capital gains, it's taxed at capital gains tax rate. Like Tim had mentioned there before, if we hold the property for longer than a year, then it falls under long-term capital gains rates, which could be 0%, depending on your filing status. Looking at the chart here, it depends on your income and depends on how much the capital gain is, very specifically. But capped out at 20%. The recapture that we talked about there is the amount of depreciation that we took. And we currently have the ability to take accelerated depreciation, whether it's through a cost segregation study or through the 60% bonus depreciation that we have, also through a cost segregation study. Same tool that we utilize. But that advanced the sped up process of taking that depreciation on the sale of the property ends up getting recaptured. And so with that, just depending on what type of depreciation was taken, it's going to be taxed, some of it as ordinary income and some of it as just a capital gains rate, essentially.
Yeah.
Won't get into specifics on those. That's something that would really need to be broken down by the CPA on the sale. But kind of at worst case scenario, running a plan like this, if my option is to make a bunch of money and get taxed at my current tax rate, whether it's high or mid or whatever, and pay that tax right now, or take some of that and invest in real estate and defer taxes and get the benefits of the real estate, and defer taxes and get the benefits of real estate, and continue that process
and buy more real estate.
And buy more real estate, exactly. and eventually I have to pay the taxes that I hadn't been paying. That's just taxed at worst case at the ordinary income rate. And so basically what I would have had to pay anyways on that money. In better cases, though, we have the ability to exchange that property for something that is like in kind, a like kind exchange, 1031 exchange is an example of that. We could sell a property and buy a property in the same tax year and offset some of our gains with losses, paper losses, again, more depreciation from a different property. Lots of different ways to do that. But really the big thing here is if we have the ability to sell the property, let's take the worst case scenario. We're selling the property and it's going to be taxed at ordinary income rates. That depends on what our AGI is for that year, what our tax rate is for that year. And so a little bit of creativity with adjustment of our AGI, lots of different ways to do this. Again, maybe you're self-employed and you have the ability to take a little bit less out of your company in a specific year and time that specifically with sale. It could be a matter of adding to different types of tax deferred accounts that would lower your AGI as well. Lots of different strategies for that. But we have the ability to tinker a little bit with our AGI. It's the same way that everybody does when they're coming up on tax time and wanting to pay less taxes for the year, right? Same thing we're talking about. So absolute worst case scenario, things are taxed at ordinary income rates, and it's the rate that we would have paid if we weren't running a strategy at all. And better case scenario, more likely, is things get deferred and deferred and deferred and just not paid. And if you keep going until you die, you just don't end up paying that tax. A good plan on how you're going to pass those properties on to your family, onto your heirs is important. And there are taxes associated with inheritance and all of that kind of stuff. But there's taxes involved with inheritance, whether or not you paid your taxes to begin with or not, whether you deferred or not. And so would you rather pay a whole bunch now and have your family pay a whole bunch then? Or would you rather not pay a whole bunch now and then have your family pay what they would have paid anyways or similar?
Yeah.
There's to each their own, but good strategies here.
And I think that there is a worst case scenario. Right?
Go on. Go on.
I think that for all those negative Nancys out there who are saying, okay, well, like, what if something bad happens? Right? Life happens. What if something bad happens and it's just it doesn't go according to plan? Maybe I've got to liquidate a house. Maybe I've got to sell one of my investment properties and I'm selling at a loss. Now I don't even have any gains to help pay back the tax side of this. And what we would advise and what we do advise with all of our clients is saying, hey, we're buying investment properties and we need to have reserves. Like, we're not just maxing out our leverage every single time we buy a property, and we're not never going to have reserves. That, like, again, every
but
problem
other people's money.
yeah. We're just going to like leverage other people's money for everything, right? No, you need to understand, like, and I'm speaking directly to the business owner here. Your biggest asset is your business. That's where cash flow, that's where money comes in. We're parking that in real estate, and we're going to use the tax benefits that allows you to do to help, one, grow more real estate, but also even grow your business, right? It's twofold. And when you can build a plan, most of the things that you're going to come across are avoidable if you plan for them. And so it's the people who get caught with their pants around their ankles and they didn't have a plan. They didn't have enough cash reserves stashed away. They leveraged their properties too much. They used too much of other people's money. And they were trying to grow too fast. And so there's always a balance here of figuring out, like, okay, I'm going to be aggressive. I'm going to be investing this money back into real estate. I'm going to be growing this for my family in the background. My goal is maybe to replace my income, my family's living expenses with real estate so that I don't have to rely on the business, right? And insulate yourself from the risk of the business. There's things that happen, but this doesn't happen overnight. It's a very, very planned out, methodical plan that we're executing every year. Yeah. And when you grow too fast, you put stress on your investments, you put stress on your finances. you put stress on your sleep.
Hmm.
And
It increases the risk. Right?
Exactly.
You don't have reserves. You are living on a razor thin edge, and things can happen. And when things happen, they cost money and sometimes force us to make decisions we wouldn't have made otherwise. So
Yeah.
Building in reserves is huge. Love that.
The only way you lose a property is if you don't pay the mortgage. And if you don't pay them, right? Like, and this is if you don't have the cash to pay the mortgage. And so make sure that you have cash. Make sure that you have reserve, make sure that you got cash flow coming in to be able to service that debt, because sometimes your tenant won't be there to pay that mortgage payment. And sometimes your tenant will be there, but they just won't pay the mortgage payment. And so you've got to learn by those tough lessons and, make sure that you're prepared. Obviously you can't dodge the bullet on everything. Life happens, things happen, right? But when you execute a plan, at least you're going to help maximize it in the near future. In worst case scenario, not worst case, but worst case scenario, you're just going to have to end up paying the same tax that you would have, or probably still less.
Probably still less
after the
taxes suck. Like we're not going to say we just love paying them. We want to minimize them at all costs. Everybody does. We have a framework that we're working within. We got a big old tax code, hundreds and thousands of pages worth of rules and minutia that we have to work within. It sucks, but it is the framework that we have to work within. So doing the best that we can with that, and just being as efficient as possible with the investments that we plan to make anyways. We just want to make sure that we are doing the best we can with what we have and growing as efficiently as possible.
Yeah, exactly. And so if you're sitting on the fence and you're thinking about getting some rental properties, or you own some properties right now, let me just show you real quick, like what we go through with every brand new client. This is kind of where we start. And I mapped it out for you just there. Let me pull this up. Here we go. I'm going to share my screen. This is where we start with every client. We have to map out your income, right? And so exactly what I just mapped out for you. This is what we sit down from the very get-go. We've got to know where your income is coming in. We've got to know where we can offset your active or passive income. And then we're going to sit down and say, okay, how much a year are we going to be able to save running this strategy? It's not just like a feel good, oh, I hope we're doing a good job and we're able to offset some taxes. It's like, no, we can calculate a pretty good estimate of what we're going to be able to do with one property, with two properties, with three properties, with the properties that you already own. And so again, if you're sitting on the fence or you already own properties and you're thinking to yourself, I'm not really sure if I'm doing this right. I don't even know if my CPA is actually filing these.
Do they know I have rentals?
Yeah. Did they ask me if I have rentals? Believe it or not, we had a client just go through that. Yeah, terrible. And so like, if you don't know what a Schedule E is, like you as an investor, right, you should know what that is. You need to be looking at that, making sure that you understand how to maximize that and the kind of the playbook that we're running here when we set up a strategy for you. So like, if you're just not sure, you're just kind of flying by the seat of your pants and you're not sure what's going on, you own some properties, you cash flow a little bit, and you're wondering what the heck is everybody talking about when they say real estate provides all these amazing tax benefits. It's time to work with someone who knows how to help you, right? It's a long, complex code. It takes a little bit of shifting with your mentality. And so it helps to sit down with somebody who knows maybe what a couple different options would look like for you and to navigate what's just going to be most optimal for you, right? There's a lot of ways to, I was going to say skin the cat, and I still did. But there's a lot of ways to solve that problem, your tax problem. But not every single one is the most efficient way for you or the most beneficial to you in terms of your time, in terms of your stress, in terms of the way that your life is operating, right? So our job is to come say, okay, what does your current life look like? How do we optimize a tax strategy that goes along with investing in real estate that's optimized for you, not you having to recreate the wheel and start all over and do all this new stuff that you've never learned about. So, the real estate market has changed over the past decade, right? As investors, we've had a lot of wind in our sails, and you can ride the boat in terms of, hey, I'm just going to bank on cash flow, or I'm going to try and, retire off cash flow in 3 years. That's just not the way our market is looking right now. We have to optimize, and we have to optimize our investments. We have to optimize our entire portfolio of rental properties to take advantage of the full benefits of real estate, which include the tax benefits. And it's just one of those pieces that have been missed over the last 10 years. CPAs have gotten lazy, agents have gotten lazy, investors have gotten lazy. They've all just been saying, hey, I'm going to take advantage of 1 or 2 of the benefits of real estate, and I'm going to forget about the other 2, 3, or 4, or 5 benefits.
Right.
And so when we look at the whole picture, step back, look at the whole picture. When you buy a new rental property, how can we maximize this? This impacts your return on investment. Like, this impacts all of those numbers. This impacts how fast you can go and buy the next property and grow that portfolio. And what do we know about when we grow a portfolio? We're able to leverage that then and grow bigger, right? I'm going to buy 4 houses and I'm going to trade up for an apartment complex. So this just speeds your entire timeline up. And so, yeah, that's what we specialize in. We want to help clients speed that timeline up, take advantage of all the benefits of real estate. We are real people. So if you're interested in working with us and getting to know us a little bit more and figuring out, hey, do we work well with you? Could we help you with your situation? You got these properties over here. You're thinking about buying some properties in the next 12 months. We want to help you on the agent side, on the strategy side. We're there for you. We're real people. We answer our DMs. We don't have people posting our posts for us. That's authentic. Every day we wake up and we try and give as much value to you guys on LinkedIn as we can. And on these live sessions like this, we want to help give as much education as possible. And then at the end of the day, there's still going to be some more questions. Everyone's situation is a little different. There's a lot of nuance in there that you got to kind of sift through to find the perfect route and path for you. So anyway, go ahead and DM us. Go ahead and reach out. Comment on this if you want, and we can just reach out to you, or DM us directly, and we'll set up a call, and we'll kind of go over this income clarity blueprint that we have built for you. And it's a good way for us to kind of get a baseline for your current situation, what you got going on, and then build a strategy from there. Awesome.
Love it.
Well, thanks, guys. Have a great Thursday night. It's been interesting popping on at night versus our kind of midday time here. So thanks for hopping on, and we look forward to hearing from you.